Richard and I are here. We're ready to take anybody's questions about it. You can drop it in the chat. You can get a little queue going. That could.
Let me jump in on a couple things.
Yeah, go ahead.
Scott, do me a favor. See if I made you the actual host and see if you can make me co-host. That's why I can't see shit. The one big shout out to our sponsors of Syndoso, Scratchpad, MedRep Meeting, Vidyard, and Outreach. If you're looking for tools, please check them out as you go in to grow into 23. We appreciate all their support. Just out of curiosity, if people would go into the chat, where are you dialing in from? Just so we get a sense and context of where everybody is.
Here we go.
Sweet.
Big spread.
That is a good spread. All over. How many people, just out of curiosity, how many people have gotten, for lack of a better phrase, screwed or didn't understand or got the, oh my God, gotcha surprise of you didn't know this about your options?
Me, I'll go first.
Yes, absolutely. Screwed. Look at them. Yep. So, and that's why we're here. Like, we're totally here to help support. So feel free to put questions in. By the way, we'd love more people to come put their video on. I know we've all got kids and cats and dogs and all that shit. So, by all means, we get it. We still don't create and encourage more engagement there. So Scott, let's just start at the very beginning, right? If you think about options, right? You're going in and they bring it up at a certain level. What's the difference between an RSU and traditional stock options? Is there a difference these days? Like, what do you know about all that kind of stuff?
Well, yes, there's a difference. There's a big difference also between actual equity, which they're giving you in a publicly traded company, and options, which they're giving you in a privately held early stage kind of startup. So that's the first thing that you should know. If you're getting stock options, you're not getting actual anything of cash value right now. It's a hope and a prayer that it turns into cash value later on. And so you need to understand the differences there. You give the definition of RSUs, Richard. Do you know the answer to that?
I actually don't. I just learned about this one like a year and a half ago. So this is the difference between me and Scott, is that it's been a while since I've had, a real job, as I like to say. So I want to make sure that, I know to ask these questions. I'm definitely not necessarily the expert on it. So,
well, RSU is essentially restricted versus unrestricted, right? And it has to do with liquidation preferences. I believe. I don't know that I know the exact definition, but I'm pretty sure it has to do with liquidation preferences once a sale or some type of liquidity event is made. And all of those people who have that restricted stock, which is usually the founders as well as the investors, they're getting paid out first. So here's an example. A couple companies ago, I had hundreds of thousands of shares, stock options, but the company sold for not enough for me to make anything. So I exercised those shares to the tune of about $64,000. They were worth at the time about $180,000. So I thought I was going to not only make a profit, but like those would grow and the profit would get even bigger. I made nothing because the only people who got paid first were the investors got paid their returns and the founder got paid their returns. And there was nothing left for any of the other executives, let alone anybody in a middle management or frontline level who had been there for a long period of time. I took this company from $0 to $25 million and I got a fat goose egg. And you could say that I actually lost money in the transaction just as it pertains to like stocks and stuff like that. So if you've got actual RSUs or actual equity, that's very different than having stock options. You're getting paid first. It's a little bit higher probability of success, let's say.
Got it. So let's go in. So you started talking. I think Colin just joined us. There he is.
There he is.
Colin.
Hey guys, sorry. I had my clock set incorrectly in the other room and I was getting ready and didn't realize I was in time.
Yeah.
Nice to see everyone. Good turnout today.
Yeah. Good deal. So we're just talking a little bit about RSUs, Colin, sort of what they are, what they aren't, and how, is there a difference when you're interviewing at a place between them offering you RSUs and more traditional stock options? Or have we just tried to perfume this pig of stock options to call them RSUs so they sound nicer and cooler?
So restricted stock options versus incentive stock options. That's the question?
Yeah.
I believe Scott might know more on this one than me. I've never had restricted. I believe it has to do with liquidation preferences and tax. I think those are the two areas that
I left off
different there.
Yeah, I left off the tax part. I talked about the liquidation preferences. Maybe you can talk to the tax part a little bit.
Yes.
I'm not sure I know the specific differences because it actually, just like stock options, it's going to vary, right? You could probably have RSUs at one company that are structured a certain way. You could probably have RSUs at another company structured another way. But if I recall correctly, RSUs are going to have a higher preference in the liquidation tree.
Yeah.
I'm not sure how that will affect your tax.
So there's a couple of thoughts. So around RSUs too, is that
When you say RSUs, are you referring to non-qualified stock options? Because that's separate,
Yes.
right? That's also or your
restricted RSUs
is the same thing.
right? So hold on. So restricted RSUs, you actually get it at that certain market price, right? Which is different than if you get the actual option to buy at a strike price, right? So let's say that's a big piece. So you have a higher propensity for some level of downturn. If you get the RSUs, you get 2,000 shares of RSUs at $22. If it goes down to 20, you're kind of screwed, right? But I think they're still guaranteed at that level. So that's one of the biggest deals, and it has to do with the vesting of those pieces. But let's talk about.
There's another piece though that I think we should maybe not confuse, because NSOs, I believe, are different. NSOs is what happens to your ISOs after you leave the company.
So
I want to make sure we're not
NSO and
confused
ISO for those who don't know.
Say that again.
Define NSO and ISO because we're using big fancy.
Yeah. So ISO is incentive stock options. That's what you're going to get when you're employed at the company, generally speaking. RSUs or RSOs, what you're talking about, I believe is different. I think that those are often used perhaps for founders or different sort of stakeholders in the company. But at least from my experience, what I've seen for employees is generally you're going to get ISOs, which are incentive stock options. They're going to vest over, a period usually of 4 years. You'll probably have sort of a cliff, like you have to be there for at least 6 months or you just lose them, right? Because they don't want people who just are sort of in and out getting a piece of the company. When you leave the company, however, by law, you can no longer have ISOs. And so depending on what is written into the agreement, you may have 30 days to exercise them or you lose them, or they will either way. If you're not exercising right away, like on the day you leave, they're going to convert to NSOs, which is just a legal thing. And again, I think the differences are a little bit to do with tax. And that's where you end up getting hit with, a tax bill, which I'm not sure if you got into, but we can get into.
Yeah, we haven't done that yet. So Scott,
we'll
tell people. Yeah, Scott, tell people what happened when you got this one of your options and all of a sudden you had to pay the taxes because you didn't really get the cash yet.
Just happened to me too, yeah.
Just happened to come too. Well, once you exercise, you're getting taxed as if it's actual income. So if I exercise, I don't know, $250,000 worth of options, that's what I have to pay in to exercise them. That $250K gets counted as income on my tax return. So I'm now paying 30-something% taxes on that, on top of the $250K I just paid to exercise them. And I don't have this actual money.
Yeah.
So this is a bit of a trick and a trap. But when you get lots of options set your way and you own a significant chunk of a company, you better have the money socked away to exercise those options.
I want to pause there. So I want to make sure everybody understands. You're granted the options when you become an employee and you vest them. So let's say you just go to your first year vest, 25% of those options, right? At that point, you have the time you could actually pay for those options, right? Because sometimes you want to do that. And the goal there is that theoretically you get, if it still has to take a couple of years for something to happen, you could pay a long-term capital gains tax versus a short-term capital gains. However,
There's another advantage too.
Yeah. What's that?
Price. Well, that's the big one, the price.
Right.
So if you get those options, I'm cutting you off just because it fits right in there, and then I'll hand it back. But let's say you get those options at $1, your strike price is $1, okay? And when you go to exercise them, the company has raised another round. They've increased the valuation of the business. So the fair market value of those options, let's say, is now $2 or $4. What Scott's talking about, when you go to exercise those, they're considering that income, the difference there, right? You just 3x'd. And so now you're going to pay taxes on that income. Now, this is not a bad thing per se. If the company is going to have a great exit, you're going to end up paying those taxes anyway someday. But it's a risk, because if the company fails tomorrow, you have now just invested all of that money in the company. You're never getting it back. The taxes you're never getting back. It's all gone. It's a wash. And so that's really, I think, the bulk of where a lot of this comes from, and why we have to have these conversations is folks go into these jobs, they get these grants, and they don't realize that it's going to cost them probably more money than they often have in their savings account to even really get them. And B, depending upon the timing of when you exercise them, you may end up paying a big tax bill that may or may not ever really amount to anything, right? It could be money lost. And so for me personally, my example, AirCall right now is the biggest investment I've ever made in my life. And I got fired from the company. So how you like them apples, right? So that's the reality of it, right? Is you put in your time, you do your year, your 2 years, your 3 years, 4 years, whatever it is. And if you really want to capitalize on what was quote unquote given to you as part of your compensation package, you now have to give to the company and to the government if the value has gone up. So you are now becoming an investor in that business.
Yep. So I want to go back because we got a couple of questions that I think matter on this. So the RSUs, or any stock option, if once you leave, the options are gone. And this becomes one of the challenges. If you're a VP of sales, right? We already know the tenure is 16 months. So they're going to throw you, 1%, hopefully, if you negotiate well. Well, they know that in 16 months, you may or may not be there. So yeah, you may get 25% of your 1% and some monthly vesting, but not the whole thing. So be mindful of these kinds of things when you're running into this. And when you leave, they just go back to the pool. Mm-hmm. They just go back to the pool.
They get to give them to somebody else.
Yes.
Yeah. So, and they account for that too, by the way. They literally, in their, closed door meetings, they expect a percentage of that to come back their way. Yes. Just to give you a framework of where, their minds are at when these are being issued.
Yep. We got a question coming from our buddy Keith. So it says, I have a startup clients who are considering whether they should or could give up equity either to the investor or early key hire. I'd welcome any insights you may have that they or I may not have thought about. So again, the question is startup. You have startup clients who are considering whether they should give up equity to investor or early key hire. So Keith, if you want to come off mute, if Scott, you'll take them off. Is there more context before we jump into answering that than you want to make sure we understand?
Thanks. Appreciate that. Actually, I'm going to leave it kind of high level because I just want to make certain if there's a couple different perspectives. So I have two clients that I'm talking to right now. Both are looking to make that. Do I get that VP of sales? Do I offer them? Trying to build that job description. And quite frankly, given the things we just talked about, I want to make sure that I and they understand all of the short-term or long-term implications of going down that path for their sake as well as this key hire.
So there's a couple of thoughts. So one I'll give you is it depends on the belief in the company, which then becomes a question of whether or not they should be interviewing there in the first place. Like, do you really believe it? Because it's interesting that you say that if the founders are questioning whether they should give up equity to early hires, that's a big red flag to me, particularly a VP of sales, because it tells me they don't understand enough. And they're just doing what their VCs are telling, which may or may not be the right thing. That's a red flag if I'm taking the job. I've taken that job and I got screwed on it. So that's my first thought on this topic. The second is, if your VP of sales is going to do it, fight like hell for 2%, 3%. We already know it's going to get tanked at 16 months or 18 months, particularly if they're the first VP of sales. Anybody here ever been the first VP of sales and you made it 3 years? Anybody? Colin, Scott? I know y'all have. Not me. Never. So That's something you got to fight tooth and nail there. And it's hard to get, particularly if the founders don't know what they're doing. So I'll pause there and see what
it's a recruiting question primarily for me, Keith. You're not going to get me to say yes to any head of sales role where there's no equity involved. None. You'd have to pay me a significantly larger sum that would make no sense, frankly. Right? Because part of the bet and the mutually shared risk is I'm going to join your tiny unknown little startup and try to make it something because I'm hoping that somehow it turns me into a millionaire. That's just the reality. And that's the shared risk. You take that part away from me. Why am I going to work there? You offer me, let's say, a $200,000 salary and a $400,000 on target earnings. Great. But this other company offers me the same thing, but gives me 1.5%. Why would I take your job? I would never. If I'm an early stage account executive, somebody who's like one of the first couple sales reps into the organization, same thing. If the comp is equal, but one company is offering stock options and the company is like product is, equally good and sellable and all that kind of stuff. If all things being equal, I would never go to the company that didn't offer me stock options. So if you're not going to offer stock options, you better be offering a whole hell of a lot of something else.
Do you, Scott? I used to run into this. It's been a long time, but people would try to lure you with a lower base salary with more stock options. They would try to lure you with this, we got to take a smaller base so that your upside's here. Do either of you, Scott or Colin, see that still happening in the world?
I think that it still happens. I think people have wised up quite a bit to that, and they don't fall for it as much. Hopefully, because people are talking about these things and educating the public, more. But it does still happen, both on an account executive and a head of sales, level, for sure. I don't think that that's Keith's situation, though. This, to me, just reads as like founders are trying to decide whether or not to give up equity. And when it comes to an investor, if you're not giving away equity to an investor, then the only person you're taking money from is like a bank. That's just a loan of some sort, and that you're paying back interest if you're not giving up ownership in the company at all. I've done a lot of angel investing in the last year and a half. I own fairly sizable chunks of a half dozen to a dozen companies. That's the exchange. That's the value exchange and the mutual risk. Colin, you want to add anything?
No, I think you hit the nail on the head. I haven't, assuming I got the question right, was are they offering less cash and more equity? And how should you react to that?
That's the question. Like in the recruiting process. Oh, Richard, we know your base salary should be $200,000 because that's the market, but
Yeah, don't do it. And like Scott said, the market should be smarter now. I think people are crazy if they offer that. They just really aren't in tune with the market. Equity it's the cherry on top, right? It's their way of saying like, hey, we're taking a huge risk here. We want you to take one with us. But that does not negate the cash compensation. You're coming in and you're doing work every day, and the cherry on top may not be there, right? And in most cases, it's not. In most cases, it will not be there. So the equity should be the cherry on top. It should be the thing that is in addition to a very fair or generous compensation package. And it should be the thing that really wants to keep you kicking when things are getting really tough, right? It's that extra thing that makes you hang on and have a little bit of, sort of buy-in to the mission in the same sense that a founder should. I also shared a link. You don't need to go through it now, but it's a good breakdown of the difference of NSOs, RSUs, and whatnot. The big difference between ISO and NSO is NSOs can be given to contractors like 1099s, whereas ISOs are going to be employee only. That's why when you leave the company, they will automatically convert to NSO.
Cool.
Thanks, gents. This was very helpful.
Yeah. So Clay, I know I asked you to come off mute and we see your question, but why don't you go ahead and give us a little more context? Like, are you looking for a gig? Are you are you a founder and you're trying to figure out what's appropriate to do for my team? Like,
Yeah, thanks, Richard. No, so I just actually landed a job at another Series A startup. And I was curious. I know a lot of people on this call are either reps or sales managers, maybe a lot of VPs too. But if you're looking at a Series A, maybe even before that, how do you know what a fair amount of equity is when they say a number? Because like I do, when I went through and got my offer, I went and did the math on the valuation, the outstanding shares, what's each share worth, and stuff like that. Could you kind of walk through some examples though of what a good amount is? Is 5,000 a lot? Is 10,000 a lot? Is 1,000 shares a lot? I think it's hard to decipher that. I'd be curious to get to walk through an example together.
Yeah, it is hard. Colin, you want to go first on this one?
Yeah, I got excited because I love the way he asked the question. 1,000 shares, 100 shares, 1,000,000 shares, gazillion shares, it means nothing. You don't know how many shares that there are in total. You need to know what piece of the pie you're getting. This is a common thing to look out for, and sometimes it's unintentional. Sometimes they're just doing it because it's really all they know is just to tell you how many shares you're getting. But you need to know what percentage of the pie you're getting. Now, as an AE, you may not be able to really get into those details. You should, but it's almost not super important. But in the
what does that mean? You should be able, you want to get into what details? What details are you talking about, Colin?
Well, so in order to know what percentage of the company you're getting, right? Knowing how many stock options they're going to give you doesn't tell you that, right? You need to know how many there are in total, right? And then that could be 4 million, 20 million. Like they usually pick a number, right? And they may issue more and they may not. So the more information you can get on that, the more you can figure out what you have actually been given. So I try to dig in and first figure out how many options in total, right, have even been created. And then how many of those are set aside into an employee pool, because they'll keep a pool of options that are basically sitting there to give out to different folks. And usually when they raise rounds of capital, they'll reset that or possibly add more to it. Sometimes they're taking some out of it. And so these are the things you want to look out for. But ultimately, you need to figure out what percentage of the company you're getting, and you need to know the valuation of the company. And if you know those things, you can figure out really what's being offered to you rather than, just a huge number, which is often, it can sound like you're getting a lot because it's this big number. But again, if you cut a pizza into 100 slices and I give you, 5 of those slices, it's still not as much pizza, right, as 5 normal slices.
Here's a let me give like a crude kind of way to think about this. Okay,
you're going to be crude. Shocking.
Not in the way that you're thinking of the word. If you're like a frontline employee, like an early stage AE, like you're talking about, if you have a really, really good outcome, congrats, you can probably buy yourself a new car. That's about it. Seriously. If you're a sales manager or even a director, somewhere in there, you can probably come up with a down payment on a new house. Maybe not in San Francisco or New York, but if you live in Cleveland, Ohio, or someplace like that, I bet you can get a down payment on your house. If you're a VP, you should be getting enough that at $100 million exit plus, there's a path there for you to make 7 figures on that particular exit. That's a real rudimentary way to look at it. It's almost like for non-executives, it's about a year's salary. For executives, it's maybe 2. Yeah, you could say it that way. I've made the joke sometimes with early stage AEs trying to negotiate equity. I'm like, you're trying to upgrade from like a Nissan Leaf to like a Honda Civic. Like, who cares? It's like, it's not going to make that much of a difference in your life. Really, it's not.
I want to pause one thing. The one thing that it will make a difference is it does become your story. It does become something you can talk about, that you were at a company at a certain stage that had an exit. That doesn't mean you go brag about the money. Yeah, when you are played, there is, so that is a underlying piece that could help your long-term growth to get to that next level of manager or VP of sales, which then may turn you into something else, but, and get you greater options. So as much as Scott likes to, I know Scott likes to talk about the Leaf and the Civic and all those kinds of things. I want to make sure people do see that. Hey, there is a good story here for you.
I'm not saying there's no value in it. I just want people to know what the value is. I can't tell you how many early stage AEs I talk to that think they're going to be a fucking millionaire because their company just sold for $100 million. Give me a break. You just got a $25,000 brand new car that you might not even want. The expectations need to be set appropriately, is my main point.
Yes. So Scott, I've heard you say this too, and can you do it, right? Like, so you're an AE or an SDR. You know, I've heard you talk about how do you optimize your salary versus options, right? Because you still preach that.
Well, I just had this conversation with somebody that we both know who will go nameless, but let's say you're an AE and in Clay's little note, I think it was a typo, but he wrote 15,000 shares, for example, right? Let's say that he gets a liquidity event and all those shares, this is going to be really crappy napkin math without tax implications and all this stuff, but bear with me. Let's say you sell those, or those are worth like $2 a pop. That's 30 grand. You could get a raise to go work for Colin's new company that pays you 40 grand a year higher in base and potentially 80 grand a year higher in total compensation. So in that type of situation, you could leave, go to this new gig, get more guaranteed in 1 year than you would get from sticking around and trying to like make this work because you have equity. And I talk to people all the time who are like, well, I'm really only staying here, Scott, because of this equity. I'm like, how many options do you have? How much longer of the vest is there? You would have to stay here for 2.5 more years to have the possibility of buying a Nissan Leaf, or you could go take this other job somewhere else and make more money now, guaranteed in cash. That's the type of math that you need to be doing in your head as you're weighing these things to see which one is worth it. That's what I was getting at, or that's what you were getting at, I think, Richard.
Yeah, that's totally it. And to some extent, it's the compounding interest.
Yeah, I would add in a piece.
Definition.
Am I on mute? Oh, no, I'm good. I would add in that, and I think this is what you were sort of hinting at or alluding to, Richard. If you're not at the executive level, and this is not going to be something that's going to necessarily or potentially change your life, right? Like it's going to be an amount of money that might actually let you put that down payment on a house or something. Sure, buying a car could change your life, right? But what could change your life more is working for the right leaders at the right company that has the right mission. And you're going to be a part of a story, like Richard mentioned, you're going to ride that coattail, right? I was very fortunate that my first job was at Single Platform that got acquired in less than 2 years for $100 million, which at the time was like these billion-dollar acquisitions now. And I got to ride that coattail, right? I got to piggyback on those introductions, and ultimately that led me to skipping over the director role and becoming a VP at Doctor.com. And before I went to Single Platform, I had been offered a job at Yelp. And those were the two that it came, and ZocDoc as well. So I had ZocDoc, Yelp, and Single Platform. Now, granted, Yelp and ZocDoc had already blown up. They had already like passed that stage of like, oh, I was part of getting them there, right? But I was able to be part of that at Single Platform. And so that for me was the right choice. I think that's very important to think about, even as an executive, but more so in those early years, because to Scott's point, that equity as an AE, it's not going to change your life. What's going to change your life more and your career more is working at the right place, the right people.
Yeah.
Also, I can throw in, I pulled up, we were talking before about what things to sort of ask for and what numbers you want to know. I pulled up my old spreadsheet. I can't show it to you, but I'll go through the different things that I used to calculate, to try to figure out what am I really getting? Where is all this equity? What does it look like? So you want to find out first, how much capital have they raised? Do they have any debt? What's the current post-money valuation of the business? How many authorized shares are there? How many issued shares are there? And how many outstanding shares are there? Issued shares is the total, right? So that could be 50 million shares. That could be 1 million shares. So usually it's a big number, and they do that because it feels bigger when you're distributing them, right? And then you want to get a sense, and this is getting a little bit into the weeds, but this will give you a sense of what's out there and what people have. How many of those shares are preferred shares versus common shares? The preferred shares are like what investors are getting, which means they're going to get paid back first, or they are going to maybe get paid back twice on their money before anyone else gets money in a liquidation event. And so asking these types of questions, some founders just may not want to get into it. Some of them may not understand it. But the more you can get these answers, the better, right? And you can have a sense. And usually you'll see something like, I don't know, 75% of the shares might be preferred and then 25% are common. And that's because the bulk of it is owned by investors, right? So that would roughly make sense. You could also try to get a sense of what percentage of the business is owned by founders, right? That's a very good thing to know, because do the founders have control over the company, or is it already controlled by the board of investors? And then that means that take what your founders tell you with a grain of salt, right? Because they may be gone next quarter, because they could be voted out, right? And so what percentage of those options, the last two pieces, are in the employee pool, which I mentioned earlier, and what percentage are investor owned, which you can kind of figure out from those numbers. Yeah, I will, while you guys are chatting, I'll put this list out here. I just can't put, obviously, my numbers in here, but I'll see if I can post a screenshot of that.
I'm trying to capture it. We got from a dictation piece. So
can I post an image into?
Yeah,
knows what
the chat
allows you to do these days.
Let's see. It does.
We got a couple of similar questions. I wonder if Jafar can ask his last question, because Clay and Jafar asked the same thing. It's essentially about optimizing for one type of compensation versus another, depending on the stage of your career. Jafar, you want to ask your question?
Yes, of course. Thanks a lot, Scott. It was a general question. I wanted to understand what is the standard ratio between the base, and I'm talking right now about the sales in general, base, OTE, and RCU or other stock options. Does it really depend on the stage of the company, or there is some standard, basically, formula that usually company follow?
Anybody want to take that one?
Sorry, I was copying this piece over here. I didn't.
All right. Go for it, Richard.
I think that depending on what role you're at, the ratio is kind of irrelevant. Unless Scott or Colin want to correct me on that, because it's never going to be significant, right? There's kind of like, I call it fuck you money when you get options, right? There's a 7-figure fuck you money, right? There's a 6-figure fuck yeah money, right? There's a 5-figure fucking A, cool, all right, that's cool, right? And then I've seen the, 4-figure, and I'm not kidding, well, fuck you company money, right? Where it's kind of like you got really screwed by somebody. So from a ratio perspective, I think that's a hard answer, because I don't see a standard. Scott, see something different? Or
well, not as pertains to, there's no ratio or formula where it's like, here's your compensation and therefore you get this amount of stock options. That doesn't exist. The most common ratio for cash is 50-50, or nowadays it's moving more towards 55% base, 45% variable to round out your on-target earnings. Those are the most common ratios by far. There's other ones, of course, but those are the most common. There is no ratio for stock options like that. There are very common sort of benchmarks. So for example, the most common kind of benchmark for a VP of sales is somewhere between 1% and 3%. 1% being far more common, 3% being reserved for somebody at an earlier stage who's been there and done this a few times and is kind of seen as like as close to a guarantee as there can be. An advisor or early engineer often gets 0.25%. A director level sales leader often gets like 1/10 of a point to 1/4 point. There's some of those benchmarks, but there's no real good formula, right? But the second part of your question, which you didn't ask, which was a part of Clay's question, which was, is it better to negotiate wages or equity? How do I optimize and prioritize for that at different stages of our career? Colin, you want to try to take that one?
Yeah, I think that's going to come down to what your preference is, first of all, right? This could be different for different folks, but let me make sure I'm getting the question right. I want to make sure the question is not, should I do that? It is, how should I do it if I want to?
No, it's how. It's like how. If I'm just getting started, I would optimize for this. If I'm old like Scott and Richard, I would optimize for this.
Okay. So again, I think this is circumstantial, right? Because I'm young, I have no kids, I'm not married. But I don't know, I could also be old with kids and still be really short on money, right? And maybe I need to optimize cash. But if I have a bunch of cash and I really am okay on the near term and I really believe in that company, well, then you might want to really try to optimize that equity. And I mean, if the question is how, I mean, this is just negotiation, right? I think it starts by just expressing that that's what you would like to do and get a sense if that's even possible. But again, I don't know that I'd play that angle. I think the angle to play is always to try to get as much of both as possible, because at least from my experience, if you're doing well, you can usually find ways to get more equity. I don't know if it's been different for you, Scott, but like if you're really, really crushing it, and this is not, I'm not just judging on my own performance, but just what I've seen and how it's been for other folks, that like if you're really crushing it and they don't want to lose you, there's nothing stopping you from, 1 year into your vest, having a sit down with your manager or your CEO and saying, I really would like to stay here and I'm thinking about how I can get more invested into the company, right? And some of the CEOs or founders will even give you chances to do this. I've been at companies where they've, it would come time at the end of a quarter to pay commission or whatnot. And, this is a bootstrapped company. And they may say, hey, does anyone want to swap their commission for more equity? Right? You don't have to, but if you would like to, and perhaps they'll give you, an extra, $1.50 worth of equity for every dollar you would have gotten in commission or something like that. So you may have opportunities like that. It's not really answering your question, but I guess I'm not sure specifically what you're asking for. Is it a negotiation tactic, or is it how to frame the conversation?
Well, I'll try to answer it, because I think I understand what.
All right, go for it.
Name. If I'm brand new in my career and I don't have a lot of entanglements or obligations or responsibilities, I might take more equity and worry less about cash, because I don't have an expensive lifestyle. I don't have mortgage payment. I don't have kids going to school, all this kind of stuff. So I might take a big swing and say, fuck it, the difference here in what could be is more important to me than what I'm getting for sure right here and now. Opposite end of that, if I'm 45 years old, married, 2 kids, mortgage payment, all this kind of stuff, I might be very locked into a particular income level.
We lose Scott.
And the stock options, while nice, is less important to me. Now I can do the opposite role play. I would argue that early in your career, the most important thing to optimize for is cash, because you're really not going to make very much in equity anyways. Like I said, it's the difference between like a $30,000 car and a $50,000 car that you're going to make. Who cares? But optimizing for cash early on in your career gives you the opportunity every time you make a step up to level up what you demand from the open market. So I started my career as a $30,000 base salary account executive full cycle. Okay. Then I became a sales manager and my base was 60. Then I moved up to senior sales manager and my base was like 75. Then I moved up to director and it was 90. Then I was a VP and it was 120. Then I was a VP again and it was this. I optimized for those things for the first like 5 or 6 years of my career, less so than equity and stock options. And then it flipped, and later on, I started optimizing more for stock options. And now I've had a few exits. I run, a successful business. If I was going to be pulled out of retirement and go be a VP of sales again, the cash that you offer me now would be irrelevant to me, because I can make more cash on my own. But if you tried to pull me in and offer me like 5-6%, now all of a sudden it gets interesting, because now I have the opportunity to have this fuck you money kind of moment. And so if you're really stable financially and you're later on in your career, you might not care as much about a $250,000 salary versus a $200,000 salary, you'd rather have an extra 0.5% in stock options. So it is very personal, but that's how I would kind of think about it and do my own kind of like mental gymnastics around what's the right move for me.
I want to make sure in those scenarios, make sure that you see the initial offer first, like before getting into those details, because you want to have that baseline of what they were going to offer you, right? So if you're going to go down that road of like having a conversation of should I go heavier on equity, heavier on cash, like get the base offer first before having that, so that at least you have a baseline for both. Otherwise, you may question like, well, would they have given me that equity anyway, right? Where I've seen that happen is particularly in bootstrap company where they were looking to bring in a sales leader and they couldn't really afford someone with a ton of experience. So they found someone who could probably do the job, and it was a bit of a risk, but they're like, look, we're taking a risk on you. We don't have a ton of money to pay out. That's why we're looking at someone that's got less experience, but we're willing to load you up on equity. And this particular person chose to take that risk. It actually turned out really well for him. He would have probably taken years to get up to that level. And so in that case, it worked out well, but it could have just as easily not worked out well. So yeah, a lot of it's got to do with just how much you believe in that business taking off and where you're at in your life.
Got a couple of questions. Colin, 23.5 people want to know why you got fired from here. No, I'm just kidding.
I'm happy to share.
But no, the other question, it's interesting, Mike, or what, wait, was it? Oh, Brian, sorry. Brian McCracken, if there's more context and you want to come off mute, let us know. We'll be glad to have you do that. But it was a great question of what happens if I leave early? Where can I sell my stock? Do I have to wait for something to happen? Right. So
great question.
There's this thing called a secondary market. And I'll let Scott and Colin jump in on that one. Either one have an answer.
Sure. You may or may not be able to sell in a secondary market. You will have to get approval from the company to do that, I believe. When I left Aircall, I immediately had people sending me emails and reaching out to me trying to buy my equity. And their approach to you will be like, hey, we see that you left and you're probably, going to lose your stock options if you don't exercise them. And if you don't have the money, like, hey, we'll buy them from you type of thing. And what they're looking to do when you get offers like that, if you get one, maybe it's questionable. If you get 3, 4, 5, you probably know your equity is going to be worth something someday because these people are trying to buy it from you at a discount for a reason. So I would only do that if it's your only option, or if you just actually think you know something about the company that they don't know. Maybe you think it's not going to be worth.
Where do you go? Like, do you have to wait? Is there like a special website called the secondary options website? Like,
there probably is. You'll probably Google companies that I don't know I forget the name of offhand who had reached out, but yeah, there's companies or investors like they're looking. Oftentimes, it may even be people who already are investors in the company and they're looking to get more. They want a bigger piece of that pie. So they're just watching people who leave the company. In that case, they probably have coordinated with the founders. In my particular case, the company did not want us selling them to third parties, although I think there's probably some legal ways to maybe push through that. But Scott, you might know more on that.
It's really hard to do is the bottom line. There's no easy place to go. There's no marketplace to be like, hey, I'm trying to sell all of my Aircall shares.
That's why if it's existing investors, there's usually a process for it. Yeah,
I've done it before. I've sold a good chunk, 6-figure plus check got written to me that I sold back to current investors who wanted more. That would be where I start. I'd ask the founders, say, hey, is there anybody on the current executive team or anybody in the current cap table on the investor group who's interested in more? I'd be interested in selling some or all of my shares. Beyond that, I mean, if your company's hot enough, it's crazy. People will just find you in the inbox.
Yep.
You don't really have to go out there and prospect for it at all. So we had a question from Melanie about negotiating. Is Melanie able to come off?
Yeah, I'm off mute. Thank you.
Great. Yeah.
So yeah, my question was just about the 4-year vesting period that's pretty common in tech startups. I was just curious if anyone has ever had success negotiating for a quicker vesting period than 4 years, or if it even makes sense to do that, or maybe even any insight on why that's the existing model, like why obviously it's like for retention, right? Wanting to retain people, but I don't know. I think people can make an impact in sooner than 4 years. So I'm just curious.
Yeah. Amen.
Put on that.
Yeah. The 4 years came from the stock market, right? That's the big downside on all of this. If you look at Sam Altman from Y Combinator, he's put together an incredible white paper on what he believes we should be moving towards, and shorter vesting for certain roles is definitely one of them. But if the question, or to answer the question of where all this came from, it came from the stock market, companies that have been doing this, not startups, right? And that's why a lot of it feels like out of place and it doesn't make a bunch of sense for us. I have never seen someone successfully get a shorter vesting period. Scott, you've been in the game longer. You've probably done it or seen it. So hand it to you.
That will almost never happen. Almost never. There's no good reason why 4 years is the gold standard. Somebody just
we want to ask some very well-known VCs, people, names you would know. We asked them where it came from, and they're like, I don't know.
There's no good reason. Somebody just did it one day and decided it was 4 and not 5 and not 3 and all that. So
Okay.
it's garbage, but
I agree.
nobody moves off of it. Nobody. But people don't move off of it at all just because it's too much of like a disruption. Here's the one place that I've seen success moving off of it. It's when you're an advisor to a company, not an operator of some sort.
Yes.
And you're really only going to be an advisor when you have 2 decades worth of experience. And you're saying to somebody, listen, it's a 2-year vest for an advisor, not a 4-year vest for an advisor. That, for whatever reason, is more of like the standard. And so you can push back on that. I've successfully pushed back on that before in some of my advisory work. People send me option agreements and it says 4 years. And I'm like, I'm not going to wait 4 years. I'm not an operator in the business. Therefore, I can't control anything happening there. Like, all I can do is give advice and you have to execute. So again, the value exchange, to be fair, like, I'm pretty sure 2 years would work just fine. And I've pulled that off before. There's also outcomes-based vesting or milestone-based vesting, which I have not read Sam Altman's paper that Colin's talking about, but my guess would be that it's something like that, because that's really what matters. Think about this, Melanie and everybody else. I get hired as a VP of sales. Okay. I did it 6 times. The last company I was at, I was there for 3 years and 1 month. I took them from no customers to 25 million plus in ARR and $1 billion plus valuation at the time. I left without being fully vested. Can you imagine? Does that seem fair in the value exchange? Wouldn't it have made more sense if somebody said to me, Scott, I know what you do. You go into early stage companies, you get them from 0 to 20 million plus or whatever. Once you do that, you're fully vested. Why would that not make sense? Why do I have to be there for 4 years? So instead, I only got 75-ish% of what I shoulda, coulda had in my original option grant, whereas they got the full benefit of what I built. You see what I'm saying? So hopefully we can start to move the needle and make some changes around the vesting, because it's bullshit. There's no real good reason for it.
There are a couple other options too. By the way, I just found an article, VentureBeat, that says in the 90s, the average time to exit a startup was 4 to 5 years. And they say that's where that came from. But I'm pretty sure that's existed since far before this world.
Now
but there is also...
It's 7 to 10 years now, by the way.
Yeah, if not longer, right? But there is also a concept called tiered vesting. I think that's what it's called. And what that is maybe you're vesting over 4 years, but you have a different percentage of your equity that vests each year. So maybe more than 25% vests in the first year. And maybe it tailors off, which they're basically saying, and I love this. I would love to get this. I've tried to get this in all of my jobs, because as a VP of sales, you're going to do most of the work in the first year. And if you do a great job, the second year should get easier, right? Because your systems are working. The people you hired are working. And so you really do. There's no question. If you spend 4 years in a VP role, you worked harder in your first 2 years than your second two, assuming you did a good job. So I think tiered vesting is I think that's one of the things Sam Altman proposes. But he also proposes longer vesting schedules for certain roles, which is interesting. So he's got some takes that I don't agree with necessarily.
So I want to jump in because we're coming up on time. There's one more question I want to bring up in a second, but again, thank you to Bidyard, Scratchpad, Outreach, MedRep Meeting, and Sendoso. That's it, right? Scott, did I miss anybody?
Nope, you got it. You got it on.
By the way, if you don't know, Surf and Sales is happening next week. Actually, Thursday. We leave Thursday. So if you have a Surf and Sales event, go register for a newsletter because we're going to announce our new one for spring in the next couple of days.
You might as well tell him right now, Richard, what the dates are.
It'll be the week of the 8th. All right. So Scott forced me to tease out of it. I'm trying to go get leads, Scott. Come on now. I'm trying to, collect email addresses.
I don't believe in MQLs, dude. I just believe in deals.
But there's one last question. Thank you to our sponsors. We'd love for people to come to the event if you haven't ever been. Check out our podcast, surfandsales.com. And then there's a great question that says, do you need to get some legal advice when you're going through all this stuff, right? Mike asked this great question of before signing the deal, who do you go talk to, right? Do you pick up the phone and call Scott and say, pick your brain, which is a tag of his from yesterday because he loves.
If you send me a bottle of Clase Azul, I will definitely have a conversation with you.
But who do you go to?
I would say, there's two things here. One is, in general, yes, you're seeking legal advice right now, technically, even though we're not lawyers and we're not giving you legal advice from a legal perspective here. But yeah, so I have sought legal advice from advisors, people who've been through this before. You can go to lawyers, right? You can go to a tax attorney who deals with this stuff. You're going to pay an hourly rate. I do recommend it at certain instances. Do you need that to figure out if you should sign an agreement or if an agreement's good? Probably not. Just if you're willing to spend the time to do the research and poke your network, I think the information is out there. The safest bet would, of course, be to consult a lawyer, especially if you're not familiar with reading through contracts and understanding how to actually interpret the verbiage, because the hard part of really making sure you're not getting screwed here is not just understanding what all this stuff means. It's actually reading through the document. I think the most important point I'll put here, and then I'll hand it off to Scott, is anything that you discuss or have in an email, or maybe an email could be used in court, but for the most part, if it's not clearly articulated in the contract, then it doesn't matter. And so you really have to know what you're reading and what you're signing, in addition to just understanding all this stuff, because you could go in and have a conversation with your CEO and they could make promises out the wazoo, but they may just hand you a document that was the same one they handed you the first time, and you may just click, to sign it, and you're screwed, right? You didn't get anything you asked for, even though they may have told you they did. And then maybe they'll be like, oh, I could have sworn that was edited, or like, who knows, right? So you have to really know how to interpret it. If you don't, you need a lawyer to do it, or someone who can look through it for you. But I think probably the most likely time that I would maybe consider spending money is really at the exercise period, when you want to consult about taxes and really figure out the best way to reduce your tax bill. That's when a tax attorney will be helpful.
I think that's right. I don't think you need to seek, I personally don't think you need to seek legal advice before signing something. There's plenty of resources online, and hopefully plenty of people in your network that you can say, hey, can you spend 2 minutes scanning this thing? Does anything look weird here? But I think it does make sense when there's money involved as far as exercising and the tax implications, or a massive liquidity event. I mean, I don't know how many of us would be prepared for suddenly $1 million hitting our bank account and what that means. It sounds nice, but it's not without entanglements. So, Richard, throw it over to you.
Yeah, I'll let you know once I confirm that I won the lottery what it's like to anticipate billions of dollars. But the last thing I want to bring up, again, thanks to everybody for joining us, and go Google this in a second. But to Scott's point, over the years, Scott and I definitely bounce back and forth. Hey, what am I missing? Just ask someone, what am I missing? Right? Find those people who've done it that you know. Find people that you admire. And it's a great way to just continue to network in a lot of ways. The other thing we didn't get into, please Google this, particularly before you sign something. And it's only because Richard's the one who always freaks out about shit, not Scott, is understanding what a double trigger is, right? Sometimes things happen, and for you to get your exercised options, two things have to happen. It could be you're terminated because they were acquired, kind of a thing. So it's a really important thing, because it's called a double trigger. So I know we're at time, so I don't want to make people sit around and listen, but definitely look that one up on Google and research that piece too. So,
Richard, did you guys touch on when to exercise? That's a big one. You might have touched before we got here, but whether to exercise as you're vesting or to exercise all at the end.
We talked about it briefly, but if you have a recommendation, go for it.
I just figured it's a good topic to make sure we have. We're up on time, but yeah, if you're concerned about when to exercise your options, I'll just throw in this quick tip. Again, it has to do with what we talked about when I first jumped on, but do you believe in the company? Are you really planning on this being a good exit? If so, there's benefits to vest or exercising as you go, because if you hold the asset for 1 year before you liquidate it, you will pay capital gains tax rather than regular tax. And so that is the advantage to exercising as soon as possible. So what some people may do is every quarter or every month, whatever their vesting period is, as soon as they're vesting a monthly, accruement of options, they're going and exercising them right away. Again, if you're iffy about the company, you may not want to do that. But that's a good way to sort of do it as you go and not get hit with this big tax bill, and then maybe reduce some taxes down to capital gains later.
Cool. All right, Colin, my man, thank you. I know Scott had to jump. Everybody else, thank you for sticking around a few extra minutes, and thank you for your time and attention. We'll get the recording and stuff out shortly. Take care, everybody.
Bye, everyone.